The most important number this quarter is 6.9%. MercadoLibre's operating margin down 600 basis points from a year ago. And it is the reason a great quarter triggered a sell-off. MercadoLibre is the dominant e-commerce and fintech platform in Latin America, the MercadoLibre marketplace plus Mercado Pago payments and credit. This quarter, revenue hit its fastest pace in roughly 4 years, while profitability was deliberately compressed. A revenue beat, an earnings miss, and a margin miss all at once. The market punished the margin line hard. Start with the growth because it is genuinely strong. Revenue came in at $8.85 billion, up 49% year over year, a beat of almost 6%. Active buyers reached 84 million, up 26%, a record 17 million added in a year. Payment volume grew 55% FX neutral. The credit book grew 87% to over $14 billion. Now the catch. Earnings per share missed consensus by about 3%, the fourth straight quarterly miss, and operating income actually fell 20% to $611 million. Here is the key point. The margin compression is intentional. Management said it plainly. They are investing in long-term growth. The drivers: higher cost of revenues, higher bad debt, and more marketing. Reinvestment, not loss of control. Where is the money going? Mostly Brazil. Cheaper shipping, faster logistics, and fast-growing credit. Brazil drove items sold up 56% and powered that record buyer growth. And the engagement data backs it up. Items per buyer rose 16%, same and next-day shipments grew 39%, and unit shipping costs fell 17%. The flywheel is working, but there is a real risk, and it is inside the credit business. The loan book is growing fast, but the quality of that growth is softening. The net interest margin after losses fell from 23% to under 18%. Non-performing loans over 90 days ticked up, and leverage rose to 1.46 times to fund it all. More loans, riskier borrowers, thinner spreads, the combination to watch if Latin American macro turns. So here is the balance. The bull case: revenue is accelerating, the valuation has reset hard, free cash flow yield nearly doubled, and the margin pressure is reversible. The bear case: 4 straight earnings misses with no margin floor, softening credit quality, and rising leverage. Here is the context that tips it. After the sell-off, the stock now trades near the low end of the analyst range, below even the most bearish target, while the average sits well above today's price. The street sees downside as largely priced in. Targets are opinion, not a floor, but the risk-reward has shifted. So my signal moves to buy. Accumulate on weakness with moderate conviction. Why only moderate? We still don't know when the margin troughs, and management hasn't said. So watch 3 things next quarter. Does the margin turn? Does credit quality hold? And does leverage stay below 1.5 times? This video is for informational purposes only and is not financial advice. Analysis is based on MercadoLibre's public earnings release dated May 7, 2026. Wall Street consensus estimates were sourced from Chartmill and StockStory, with analyst ratings from TipRanks, all retrieved May 26, 2026. Past performance does not guarantee future results. Always do your own research before making investment decisions.